to you. Today is Tuesday, January 13th, 2026. My name is Francisco Gaffney, and this is my daily live streaming all about governance, risk, compliance, and advisory boards. And continuing with my observation of a large PLC listed in the London Stock Exchange, today first, a bit of context. Yesterday, I talked about why their refinancing fails after the press release. It's not that they fail, it's actually my observations of why many of these refinances could fail after they announced their refinancing. And today, I'm going to go to certain root causes behind many failed restructurings. So it doesn't mean that this company in particular is failing. It means actually, in observation of what they are doing, what are the lessons that we can learn as they go along based on the public records. So one of the first things that they have is that the business model is still tied to headcounts, and then recovery plans assumes leverage, right? So let's separate two things that boards often bundle together. So the first one is scale, and the second thing is scalability. So if you want a short definition of scale, is having more people and more contracts. And scalability is producing more value without needing proportionally more people. Meaning, in other words, if you may, do more with less. So what is the problem here? And actually, I'm going to identify three problems. Number one is the UK productivity remains a live constraint. So the UK Office for National Statistics reports that the output per hour in Q2 2025, which is the latest published, was only 1.5% above 2019 levels, and also notes that underlying weakness in productivity growth. So that means when productivity is sticky, if you may, hire more increases cost faster than capability unless the method changes. Problem number two is that the UK economy is already telling us where scalable value sits. And this is coming from the Office of National Statistics, again, that estimates that UK investment in intangible assets exceeds tangible investment in 2023. And again, the latest report published, and identifies software as the largest capitalized intangible category. So boards looking for margin recovery should expect the answer to involve software, systems, and organizational capital, not only the cost takeout. And again, with this example that I'm following, this PLC that I'm observing, management recovery ambition implies a rapid move from labor-heavy delivery to a higher value digital outcomes. At the same time, they have a large legacy infrastructure base that continues to operate at low single-digit margins. This is why cost-cutting alone cannot deliver low double-digit margin targets. The model must change its unit economics, not only its overhead. So, in simple terms, trying to hit a double-digit margin with a headcount-led model is like trying to win a race by carrying more fuel rather than fixing the car's engine. So you can imagine that how much fuel you can hold to the point that the weight of the fuel will not allow you to be competitive anymore or make you lose your competitive edge, right? So it's too heavy compared to what you want to achieve. So you have to fix the engine. This is where the boards sometimes feel uncomfortable facing this reality, because if the delivery model is still bespoke, they scale effort. They don't scale anything else. But if the model is productized, you scale capability. And in a restructuring window, the time is the enemy because you're working on the schedule. So because lenders and markets do not wait for culture change. So what they want evidence that the things are working. So what evidence should boards demand when these cases of restructuring happen in terms of scale and scalability? And particularly looking into the example of this PLC in the London Stock Exchange. So, and And here, as a board advisor, if you may, this is what I will propose to consider in this case. I will go to the board and say, can we look in these three things as a consideration? Number one, run an IP audit with product intent in mind. Identify which modules in the high-value digital and security state can be separated from professional service and sold as a repeatable software or license capability. Remember that the UK intangible investment data is that software is where scalable value concentrates and where markets reward resilience. The second suggestion would be productize the legacy turnaround into a system asset, convert the infrastructure stabilization play into a standard operation procedure with automation, controls, and repeatable monitoring. Again, the UK Corporate Governance Code asks boards to monitor and review material controls and make a declaration of their effectiveness, including reporting controls, because systemization makes that declaration defensible. And defensibility is based on evidence, as we mentioned, and evidence is what it makes it best position in terms of defensibility. So it's kind of a tongue twister, but defensible and evidence goes tied together. And the third suggestion is realign sales incentives from headline contract value to recurring high margin revenue. So move key performance indicators toward annual recurring revenue and margin weighting recurring outcomes, but tighten how you report them. So in terms of reporting, there's a lot of literature in terms of general accepted accounting practices and the European Securities and Markets Authorities, alternative performance measures. But the bottom line is boards or the practices must be transparent, reconciled, and not misleading. So in that third point is where the boards can add immediate value. And particularly in this case, I'm studying what I'm watching what they are doing. I say, well, this is immediate value here. So if they incentivize total contract value, people will sell complexity. If they incentivize recurrent revenue with margin weighting, people will sell repeatability. And this is tied to resilience and the restructuring that they are doing. So this is, let's say, a instant, or this is where the boards must insist in a clean reporting. Annual recurring revenue can be useful, but if it's defined loosely, it becomes a narrative tool rather than a performance tool. So the board job is not to ban the metric. In reality, is to force clarity, as we mentioned again in terms of the accounting portions, the transparent, reconciled, and not misleading. So they need to define it, they need to reconcile it, and explain why it matters. Then, with that, they can use it to drive behavior. And why does this approach matter? For three things: outcomes, differentiators, and risk reduction. In terms of outcomes, against the UK Office for National Statistics, the productivity picture reinforces that margin recovery through effort has limits. So systems and products leverage is the credible route to compounding output. In terms of differentiators, the UK own investment pattern shows where resilience is built: intangible investment led by software and organizational capital, and now exceeds the tangible investments that aligns directly with the product and system asset strategy that we mentioned earlier. And how it helps to reduce the risk is a governance and reporting expectation can be used as a forcing function. So push boards toward evidence-based operating maturity rather than optimistic storytelling. So what feels like the next best step for today? Not a full reorg, you already gone through that, not another cost program, but a clarity test. Just test this with one action. Ask your management for one page, a view showing revenue per employee trend, the percentage of revenue that is truly recurring, and the top 5 working packages being productized into repeatable software or standard operation procedures in the next 2 quarters. If the page cannot be produced clearly and cleanly, I think you have your answer. The model is still people-led. And if you're in the receiving end, if you're in the executive team where your board needs to decouple growth from headcount while maintaining reporting credibility, book a structured diagnosis session with your own team to map product candidates, system assets, and key performance indicators definitions that lenders, and markets will accept. Right? So let's pause today and let's reconvene tomorrow, because tomorrow I will move from internal economics to external defense and why ecosystem trust and digital sovereignty can be a moat, but only if your product and the system assets are real. And if this resonates with you or mirrors what you're seeing inside your organization, you probably want to stay with this series, because this week is quite interesting in terms of the example that I'm using. And if you want to consider a board of advisors for your company, just ping me on LinkedIn and I'll be happy to have a chat to understand which is your position, what you're looking for, and to see if we can help you.